Hey everyone, Sarah here with Exit Realty Bitterroot Valley here in the beautiful Darby, Montana today on a beautiful Thursday. I just want to talk to you today about capital gains tax. I knew a lot about this because of my accounting degree, but there are some things that I actually didn't know. So I want to share all of the information with you so that way you can be informed as well, because I think it's really important when buying and selling real estate. So capital gains is taxable income over $250,000 gained from the sale of either an asset, business, or shares of a stock. So anything over 250 gets taxed. 250,000 gets taxed. There is, in Montana, there is a credit to that capital gains tax that you can qualify for. It saves you 2%. So it takes the capital gains tax from 6.9% to 4.9%. So when you do your taxes for Montana, make sure that you apply that credit, that 2% credit, because that will save you a bunch of money. 2% on a large sum of money is a large sum of money. So let's see, collectibles is something that needs to be addressed. If you sell art, jewelry, antiques, stamps, any kind of collectible, they are taxed at 28%. So be careful about that, because that's really steep. That's really expensive. So like I said, anything that you buy or sell that gives you a profit of $250,000 or more is going to be taxed as capital gains. So, excuse me. So let's say you buy a house for, let's say $200,000 and you sell it for $500,000. That's your profit of $300,000. So post the 250, you have a remaining 50,000. Tracking? So you will be taxed on that excess of $50,000 capital gains. Okay, so that's something you need to be in mind. The limit for married filing jointly is different. It's not 250, it's 500,000. So be aware of that. So if you are married filing jointly, you get a little bit more of a break. Let's see. As far as investors go, this is something that I didn't track on before. I didn't know where the limits were, but investors. So they can take depreciation, but when it goes towards the sale, the depreciation isn't counted, because then the difference between the sale and the value of the capital gains is larger. So they don't make depreciation count when selling for investors. So for example, if you pay $100,000 for a business and your depreciation amount for that is $5,000, so that puts you at $95,000 is what the business is worth. Well, then when you go to sell it and you sell it for $110,000, that gives you a profit of $15,000. So you got the 110 over the 100 plus the $5,000 depreciation, right? So you're at $15,000 profit. Well, the IRS won't consider the $5,000 as capital gains tax. It's actually taxed on its own. So the depreciation is going to be taxed at 25% regardless of income. And then the remaining $10,000 is taxed at 10% or 10%, 15%, or 20% depending on your income. So that is like a sliding scale for that. Married filing jointly, if your income exceeds $250,000, married filing jointly, $200,000 for single or head of household, $125,000 for married filing separately, and then your investment income gets taxed another 3.8%. So what I'm trying to say is that you can extra 3.8% tax on your capital gains if your income exceeds $250,000 if you're married, $200,000 if you're single or head of household, and $125,000 if you're married filing separately. So that's some things that you need to be aware of. Let's see, how do you get out of it? That's the real question, right? So how to combat capital gains. So you can use excess losses. as a counter to your capital gains. So say for example, you gain 5,000 from stocks, but then you lose 20,000 in some other stocks. So that would offset it. So you can actually claim the loss, the capital gains loss of $15,000, and that will help counter any capital gains that you have from real estate. So that's something to consider. You need to be careful because a lot of people play this game. There is a wash sale rule with the IRS. Some people will sell their stocks right before tax time for a loss, and then immediately after filing taxes, they will buy them back for the same price. The IRS is on to you. Don't try and fool them. You can't buy them back within 30 days. So you gotta wait after 30 days if you wanna play that game. Some people will use retirement accounts to buy and sell stocks because you are not taxed capital gains within a retirement account. So something to keep in mind of. So let's see. You can sell your property after your retirement. Here's a trick. You can sell your property after retirement because your income during retirement is probably going to be lower than when you are making an active income. So sell your property so that way your tax percentage is based off of your lower income rate as opposed to selling while you're working and have an higher income. So those are the things that you can do to kind of combat that capital gains tax. Anyways, I hope this was helpful and informative, and I look forward to talking to you guys soon. All right, thanks. Bye.